Welcome back, ladies and gentlemen, for another weekly video. As always, I'm joined here by our Deputy CIO, Will McGuff. Now, we have had quite the tumultuous first half of the year, with Q1 being riddled by tariff and trade policy news, and Q2 coming roaring back. So without further ado, Will, could you break us down why did Q2 rally so hard, and where are we sitting year to date so far?
Yeah, thanks, Clayton, and thanks everybody for joining in. We're going to switch gears a little bit on this video and do a recap, which we don't usually do about the market. So it really was a tale of two quarters to start the year. Q1 down, Liberation Day with the administration's trade negotiations and tariff policies hit right after quarter end, which sent stocks down further. S&P 500 barely missed a 20% drawdown, which is a bear market territory definition. I think we probably rounded to 20. But didn't quite get there on an absolute basis. And really since then it was, the taco trade that ultimately had folks realize that the markets were overreacting to what was going on. And here we are back at all-time highs.
Will, for those of the people that are listening in that don't know, could you break down what the taco trade is for us real quick?
Yeah, so essentially the administration is very capitalistic. They're negotiators, and so they take their business principles and are applying it to politics. And so what we've seen is the trade negotiations and tariffs be used as tools to help them ultimately get the best deals for the United States. Now, it's caused a lot of problems with volatility. People don't know which way things are going to go. The market hates uncertainty. We saw VIX spike because of said uncertainty, but as the negotiations went on, market participants realized that, hey, maybe tariffs aren't necessarily all that bad. We're not seeing them flow through to the inflation. We'll get into the Fed and rates here in a bit. But essentially what's happened is markets are back at all-time highs. We'll show a chart here of major U.S., world, and fixed income markets. So these are ETFs, so they're net returns of their expense ratios. So you can actually go out and buy these ETFs if you wanted to. And each group is sorted by the return year to date. And this is all through the end of the second quarter. We'll see NASDAQ 100, which is the QQQ, is up about 8%. SPY, which represents the S&P 500, is up about 6%. And so if we look at the quarter to date, those numbers are much bigger than the year to date, which ultimately show that we recovered Q1's drawdown with gains in Q2. But the real story this year is the world markets. You'll see Germany's up almost 35%, which is a big move. World markets have historically underperformed the U.S. over the last 10 or 15 years, and we're seeing that trend change. So it's something to be very aware of. Work with your financial advisor and making sure you have the right asset allocation amongst U.S. and international stocks. And lastly, on the far right, we have fixed income. These are fixed income ETFs, so they represent bonds. When bonds are up, rates are down. When rates are up, bonds are down. And so what we see for the year is that rates are actually down a little bit, which means these fixed income ETFs are up. So AGG is the most popular barometer in the fixed income world. It's up about 4% year to date. So whether you're invested in the US, internationally, or in fixed income, most everything is green, which is great for investors. Now, in the US, we'll see that tech has led the charge. But I'm curious, Clayton, from your view with regards to how you look at stock analysis, an ETF like QUAL, which looks for quality companies that have solid earnings, is only up 3%. So it's trailing the S&P 500. I'm curious from a bottom-up perspective why you may think that's happening right now.
Yeah, I think that's a great question, Will, and I think you hit a lot of the nails on the head about what happened in Q1, Q2, and a lot of the paradigm shifts that we're seeing year to date so far. Now, in regards to why QUAL or an ETF such as that may be lagging, the triple Qs or SPY is unlike SPY and QQQ. They are going to have probably a less pronounced allocation to names such as the Mag 7, where SPY and QQQ are more of a market cap weighted index and ETF trackers. So you're going to have a lot higher weightings to the Teslas of the world, Meta, Google, Amazon, Apple, all the Mag 7 like we always talk about. QUAL is going to be a little bit more diversified, not going to have nearly the type of stock concentration that those other ETFs are going to hold. So when you see a very concentrated rally or just a more concentrated sector rally like we've seen in tech over the last quarter or so, you're going to have a more diversified ETF that has a stricter kind of objective mandate like QUAL, which is looking for durable earnings, competitive moats, and things of that nature that are more long-term in nature, you're going to, at times, underperform to the upside. Perfect example, QQQ, SPY, Tesla is a major holding in both of those ETFs. And meanwhile, in QUAL, it may not be in ETF or meet a lot of the criteria that a more bespoke ETF adheres to. Meanwhile, Tesla had a 30+% rally in Q2, meaning that if you're not holding, one of those stocks that had a concentrated rally like that, you're due to underperform on that upside. So there are, in the end, you got to figure out what's the mandate of this ETF and how does it differ from the index, and why is that performance difference really coming through. So that would be kind of my insight on that. Now, what should we be looking forward to, Will, in the later half of the year? You've kind of done a great job going through like, hey, this is Q1, this is Q2, this is where we're sitting here today and what's been driving everything, which has obviously been trade. But is there anything that investors and our clients should really be focusing on for the second half of the year?
Right. So I'm actually pick up on a word you mentioned a few times there, which is concentration. You were talking about it in the large cap realm with the Mag 7 versus other large cap stocks. But as I talked about right before you spoke, world markets have done well, fixed income markets have done well. So I would like to see the market broaden down to small caps here in the States starting to do well. A lot of folks got very bullish on this administration's second try through the election, and small cap stocks ripped on the backs of lower energy prices and deregulation. So I think some of those themes should hopefully percolate the way through now that trade negotiations and big beautiful bill are hopefully going to move to the backseat. That said, what happens with that bill and deficit spending is going to drive a lot of what happens in the second half of this year, which gets me back towards the key focus. I think is going to be, when is the Fed going to cut? The 2-year Treasury is about 3.7%. The Fed's sitting at 4.5%. Every major central bank around the world is in an easing cycle and has eased sooner rather than later, which is where the Fed is right now. So I think that Powell's term is up next year, so their forward guidance is a little murky. They don't have forward guidance like Bernanke and Yellen had because everybody knows that he's pretty much a lame duck in the Fed chair seat right now. So where interest rates go with regards to what the Fed is going to do is going to be the major narrative of the second half of this year. And it could add a lot of volatility both in equity and fixed income, which gets back ultimately towards working with your advisor to make sure that you have the right amount of risk in your portfolio and set allocation to equities and fixed income. So with that, I'll turn it back over to you for closing thoughts, Clayton.
Yeah, well, I think you did a great job summing that up. Obviously, the entire market in the world has been waiting on what the Fed is going to do. Now, just to piggyback off what you said, a lot of the forecasts that we're seeing is we might be getting a cut in the September meeting. But like you said, Powell and his committee kind of right now are sitting in a lame duck status and kind of adversarial to the administration. So anytime a new headline comes out, obviously there's going to be ripple effects to the Fed. But I want to hit that key point that you said, which is always make sure that you're communicating with your advisor and making sure you're allocated in the appropriate way for your specific objective. Don't try to go it alone. Rely on the people that you trust and the professionals here to help you out. As always, if you are not connected with a financial advisor and you'd like to find one, please follow our link. We'd love to get you connected with somebody. But as always, please stay invested, stay informed, and we'll make sure to keep you updated on every twist and turn in the market. Until next time.